The fab capacity. The basics of manufacturing have not changed in 30 years. It still takes a year to build a factory. It still takes a year to build the building. It always has done. It's just that the factories we build today are more complicated. So all of the productivity that we've gained, we just simply plough back in to making the factories more and more complex. But it still takes you the same amount of time. Basically, if I order a piece of equipment today, that will not be wafer fab production ready for 3 months, well, 3 quarters, which then gives me units out in another quarter after that. So I cannot influence capacity for a year. I can't do anything about it. Whatever capacity is in place today and the quick kit that I've ordered over the last few quarters, that is it. I can't change. The earliest I can change capacity is October 2014. Everything else is set in stone. So whatever we've done in the last year, we have to live with. And we've been building capacity at a rate which I think is reasonably dangerous in terms of the ability to meet new demand. The supply time lead times are incredibly long. It's still 3 months for a wafer fab. 1.3 days per mask is about the best you can do. Memories are a bit faster than that because it's a lot simpler process in many ways. But basically, when you're talking about advanced logic, you're looking at about 1.3 days per mask. So you had 50 masks, 60 masks, 70 masks, work it out for yourself. That's how long it takes. The chart here simply tracks the amount of equipment ordered versus the new capacity coming on stream. And it just shows this 2-quarter delay. It just takes that amount of time between accepting delivery of the equipment and then actually cooking it up and getting it ready to run high volume wafers. I'm not talking about running small quantity wafers, I'm talking about committing that factory to running lots and lots of wafers. And this is an operational decision. You are not going to run 5,000 wafer starts a day through something you don't guarantee is going to come out good product there. So you have to be absolutely confident that that thing is going to work, and that just takes time. And that's the 2 quarters that it takes. This is the book-to-bill ratio of the front-end equipment, wafer fab equipment, the wafer processing equipment. This is the stuff that actually patterns the wafer. And this is simply looking at this here. It goes back for 8 years. I can go back longer. But I just chose this period in time here. The red outpaces the green. That means that over that long-term trend, over the last 8 years, we have been under-investing over that long period in time there, in terms of the traditional norms of what we'd expect in the industry. When you plot this chart for the back end, the red and the green counterbalance each other. There are almost for every red there's a green, and overall the average is pretty neutral. So this tells you here that we are getting we're getting super productivity out of our fabs, we're really getting efficient, we're really running these things much, much better than we ever used to. And to a certain extent that is true, because we've had consolidation in the wafer fab manufacturing industry. So you haven't had the excess capacity being built by Motorola and TI and everybody else all building factories. Now you've only got a few factories being built, a few companies building them, so they are planning their capex much more efficiently. But the fact remains is that you have to ask yourself the question, are we really investing in the same way, ready to have the capacity ready? And the tendency is that we're now investing slightly behind rather than ahead. And that's quite reasonable because you don't want to have excess capacity, especially at the leading edge. It's too expensive. You want to have just about the right amount at the right time. And that is the hardest thing to judge, because you're planning capacity 2 years ahead and your unit demand you get the best 3 months notice about, less than that probably in most cases here. Longer term, the capacity has to track unit growth because the average number of integrated circuits per wafer start has again been pretty constant over the last 30 years. That's because every die we shrink, we make a more complex die. And you've had about a 1% productivity gain on this number here. So if the units are growing 10 or 11%, take off 1 or 2 percentage points for productivity gain, that means capacity has to grow 9% a year. And that's part of the motivation for moving to 450mm. Build one 450mm fab rather than 2 300mm fabs. You get the efficiency of building one development rather than 2 developments. So these issues here are all fundamental trend lines in the industry which have to be balanced and played off against each other to give you some confidence in how the industry is likely to perform in the future. The dynamics of investment in the industry are absolutely insane. The blue chart is the year-on-year dynamics of the semiconductor industry. The red chart is the year-on-year dynamics of the equipment industry. This is what we treat Tokyo Electron, Applied Materials, ASML lithography. This is how we treat them. Their dynamics are 3 times worse than the chip industry dynamics. So if you think we get swings of 60%, they get swings of 200%. And they're expected at the same time to develop leading edge technology, develop 450 millimeters, when that's their investment profile, that's their capex spend. And you have to ask yourself the question, without the equipment industry, I don't have the advanced technology. I mean, the advanced technology isn't developed in the semiconductor fab. The advanced technology is developed and given to you by the equipment people. It's them that enable the advanced technology those to happen, and yet we mistreat them in this way here, in this very cavalier way. This looks at the capital spend as a percent of sales. The norm used to be in terms of the front end, this is front end capacity, not overall capacity. The norm on the front end used to be around 10 to 12%, something like that. We've now been running consistently at the 8 to 10% level. And it's now gone back down again here. The data for the Q1, Q2 actually, was under 8%. So this is in a period where we're trying to ramp up 20 nanometer nodes, we're trying to do all this kind of stuff here, and yet we're spending less money as a percent of revenue. Now partly that is because the chip market hasn't been growing, okay? So we're paced by a number there, which maybe we're not measuring against the right thing here. But again, you just have to ask yourself, is this the right amount of spend? Are we building ourselves a problem for tomorrow? Is there a capacity crunch around the corner? Because we're managing it okay now at today's level of demand. What happens when demand increases a little bit? If demand increases next year, you won't be able to meet that demand because the capacity is already fixed. And that's fixed by the spend that was there, which was under the 10% trend line. And again, maybe take off some bit for the improved efficiencies, take off the bit because TSMC and Global Foundries are much better at running wafer fabs and Freescale, and TI were better at running fabs and things like that. You can make all those judgments on there, but the question is, no one knows whether it's the right number or the wrong number. It's a huge risk. Average selling prices are much more complex. If anybody remembers TTL, I cut my teeth on TTL. It taught me so much about the chip industry. It taught me so much about average selling prices. The average selling price, when you actually look at it, that black line there, the average selling price is also constant over time. So again, for every complex chip which you get more money for, you have a cheaper chip which you've cost reduced for the same complexity. And you see this remarkably long cycle on there. That's an 8 to 10 year cycle. I wish I could have the time and the funding to analyze what caused that cycle there. It's a very interesting piece of data. But you have all this noise on the chart there going up, and then you have some kind of a crisis, an economic crisis driving it down again. But the fact remains is the long-term trend through that there, again, has been flat. Over the last couple of years, we've seen the trend slightly negative. It has been changing, it's gone up and down a little bit more there, but it's slightly negative. But if history does repeat itself, and the chances are that it probably will, particularly if there becomes a little bit of a shortage, as we've seen in memories, look at the price of memories. There's capacity shortage in memory, look what's happened to memory prices. Okay, the ASP in memories has gone up significantly over the last year. So again, you can look at this and say, well, the ASP trend line is probability, balance of probabilities likely to trend up again, because it has been doing that over the last 30 years or so. There's no reason why it won't do that at all in the future. And the average revenue per wafer start, again, it's been constant. The die classic $9 a square centimeter. Now, if you're Intel, you've got $100 a square centimeter. Maybe the emphasis is on GOT. Maybe that's changed. Maybe it's going to come down a little bit now. If you're selling lower end products, you don't get that much. If you're selling memories, you get a little bit less than $9 a square centimeter. So it does depend on the product, it does depend on the company, but the average for the industry is $9 per square centimeter. And that's where we have been trending again for a very long period of time. So the fundamentals of those issues there have been very, we're looking at a situation now whereby the economy is essentially on hold. Someone's pressed the pause button, and we've yet to hit that play button again, and no one's going to hit the play button until they're really certain that it's going to play out. The unit demand is already even above that trend line slightly. When you look at the data over the last 18 months, that trend line has been higher than the average there. Partly that is because everything was depleted back now, and we're now living off the demand itself, and that has been increasing. And the fab capacity is tight, especially at leading edge. You'd expect it to be tight at the leading edge. It is tight there, and the ASPs, we believe, are following their normal structural type of historical trend there. You do get these periods of ups and downs, but that ups and downs is a 8 to 10 year cycle. So there's no point in looking at last month, no point in looking at last quarter, last year, last 2 years. You've got to look at that over a very long period of time to see how that is trending out and where you are in that part of the cycle. So each of these have its own cycle. Some are long, some are short, and you have to put them all together and then make a judgment of balance of probabilities on what is likely to happen. Which leads us to the forecast. And the first question you always ask is, well, how well did you do last year? And so we will tell you how well we did last year. What was our forecast for last year, and what was the forecast going to be for this year? This chart came from the presentation I made last year, slide 48. If you don't believe me, check the presentation. I haven't frigged it, I haven't cheated it, I haven't readjusted it, I haven't rewritten the volumes there. A straight copy of the slide. That's what we told you this time last year. We said that the 2012 market would be flat, plus or minus 1%, something like that. We also said that we expected the economy to slightly improve as the year rolled out, and that's what gave us that number here. The actual result was minus 2.7%. So why? Because the economy did not improve in the fourth quarter of last year, and that just slowed everything right down, and it took the fourth quarter number down, and that took the yearly number down to minus 2.7%. So, yeah, I mean, yes, if the economy slows down, it doesn't do what you think it's going to do, what you expect it's going to do. There is this direct impact on the chip market there, and we did have a few let-out clauses there, but it did assume no wars, floods, fires, bank meltdowns, economic collapses, plagues, floods, water explosions, a whole bunch of exclusions. And of course, a lot of those exclusions did happen, and the whole thing is it was not as robust, and people cut back. Our outlook for 2014, what we said at the beginning of this year was that we should see about a 7% growth for the 2014 number. We gave out a series of quarterly numbers there as to how we thought that pattern would roll out. When we reviewed that at our 6-monthly forecast seminar, the first quarter turned out to be a lot worse. That hangover from the fourth quarter slowed down, really impacted the first quarter. And if you looked at the numbers there, it would have reduced that 7% forecast down to about 4%, something like that. We took the view back then that actually, 4%, 6%, we're not going to change the forecast. So we held with the forecast because we thought there was enough upside, there was enough positiveness there to keep that whole thing on that 6-7% type number. And we don't make adjustments from 6.9% to 6%. It's telling you the same story. Okay, we're not in the business of guessing the exact number. We're more interested in telling you the trends, what to look out for, and what the likely output of that number would be. Looking at the forecast to tell you now, again, I'm going to take the view of saying it's not worth changing it. I mean, it probably will come down to 6% rather than 6.9%. We said the third quarter has got to grow something around 10%. The third quarter is over, the results aren't out. Depending on who you talk to, although most companies aren't allowed to talk to you because the data is, hasn't been released, so you can't talk to you anymore. But some people have done worse than that, some people have done better than that. So it'll be interesting to see how that does shape out altogether. It probably won't be a 10% fourth quarter growth, it might be 8%. But when you look at the dynamics of the number, the fourth quarter only has to be 3% growth and it gets you back to 7% again. So again, the real numbers have changed slightly, but the message hasn't changed. We still have the economic situation, but it looks like it is holding its own. And so a number of around 6-7% is still a good number, and we're not going to change that at this point in time. This was our outlook for the 2014-2017 period, and what we said and have always said is that if the market does recover this year in terms of a 7% number with a good quarterly flow from that there, then eventually that is going to give you a very strong growth year very quickly in recovery. And we picked a number of 25%. Okay, now you could say, oh, what have you been smoking, Malcolm? You know, it's a party tonight, that's good. 25%, it's a good number. It is a good number. And why do we say that? Because 2 years ago only, we had a 32% growth year. So, you know, 25% is not really an aggressive number. It's just simply a statement of fact that when this industry does actually get traction in the recovery there, you're going to have a year of extremely high growth rate because you'll be coming from such a low base. You'll be growing on a quarter-by-quarter basis, and that amplifies itself out into a double-digit number. It's just simply mathematics. That's how it works. So at some point in time, if it's 2014, maybe if it slips, it'll be 2015. The very next year of full growth after the recovery period is going to be double-digit. There is nothing you can do about that because the industry will not be able to catch up. And you'll probably have a second year of strong growth after that as well, before again then you get the adjustment period kicking in there. So, you know, it could be a lot higher than 25%, depending on the timing of that recovery there. Slip it a quarter, it does change the number, but it doesn't change the dynamic. 450mm, we can't have a presentation without some measure on that there. We've been working on 450mm since 2010, officially. A little bit before that as well. And, you know, I guess we claim to be the world's leading research expert on 450mm, and I think that's a claim we can rightfully claim. We are involved in some of the European projects now, working on these, and we certainly have spent a lot of time and energy looking at this. In terms of actually, it really started back in this meeting here that we had with the Commission, our Silicon Chip Industry Awareness Workshop. The Commission asked us to have this workshop in there for their people in April 2009. That's when they started to understand, a lot of them did already, but they were starting to try to propagate the message that manufacturing was important. And we've always felt that. And you know, we held this workshop here, and that again helped sow the seeds of spreading the reason why manufacturing is important. This was the chart we did of the 450mm transition for the report that was published in 2010, late 2010, and the rollout there simply said demo tools in 2013, yeah, that's happening. The first production tools, the early production tools, 2015-ish, and then the first generation real production tools starting in 2018. And in the spirit of that rollout there, we still feel that that is still a reasonable judgment of how it might be. Now the first rollout there, the Q1, Generation 1 production tools, it might slip 6 months. There's some indications that it might be pushed out a little bit there, but it's not going to change the dynamics of the whole equation here. There's still a lot of uncertainty about it, the effectiveness of it, is it worth it, the commitment to it, a lot of issues to resolve there, but in general, the progress is pretty much rolling out as we would expect. There are different aspects of views on this here. You find that the three big chip companies, the leading ones, Intel, Samsung and TSMC, they're kind of saying yes. A little bit of a sort of yes to that there, but they're still not putting their money on the table. They're still not actually funding the first generation of production tools there, but it is a reasonably strong yes. The equipment industry, they're very much divided down the middle. And most of the